Hi, this is Ryan with our debtfreelives.com. Today we're going to cover mutual funds, and really what we're going to focus in on is looking at how do you even go about finding a mutual fund. So we're going to review some free screeners that you can use to find mutual funds, and we'll go over the different asset options available. So what we're going to do first is we're going to start off by covering we're going to use Fidelity's mutual fund screener, and then also Yahoo Finance. And again, these are both free, and it doesn't require, Fidelity doesn't require that you be a customer. So even if you don't have Fidelity, you can still use their screener. So let's go ahead and get started.
Okay, so the first thing we'll want to do to access the Fidelity Mutual Fund screener is just go to Fidelity's website. Okay, and then once you're here, you'll go under News and Research, and then we'll select mutual funds. Okay, so the first thing you'll notice with this is you have a few different options here. So this is just to help you refine your search. So with Fidelity, you have some Fidelity-only funds, some fund picks from Fidelity. These are just ones that Fidelity recommends. And then there's also for no transaction fee funds. This is going to be the box that you'll want to check. So over here on the left side, you'll notice we have by class, category, and by risk. So if we look at asset class, the first thing you'll notice is it's going to be broken into different categories. And again, if you go use the Yahoo Finance fund screener, you'll notice that they have a little bit different categorization. But basically what you have here is there's allocation is basically just going to go through and show you, for example, if you want 15 to 30% allocated to equities. This is actually one of probably the better asset allocations if you're just beginning and you're not too sure on what you want to do yet. So they have these funds that are called target dates. And what that does is that basically is your expected retire date. And so it'll have a different asset allocation. So if we look at, for example, the target date for 2000 to 2010, you'll notice that it's very conservative. It's going to have very little in equity. So it'll be the allocation will be closer to 15 to 30% in equity, while the rest is going to be in bonds and things such as that. So as you move out to here, so if you select a target date of 2060, you'll notice that it's mostly going to consist of higher risk, things such as it'll be mostly in equities with very little in conservative investments. And so those higher risk areas do tend to have higher returns. You know, again, if you're looking at the long run. But if you're retiring soon, you're going to want something more stable. So this is the basic asset allocation when you use the mutual fund. Now, when we move on to alternate, you can see you have a number of different types. So you can go through volatility, bear market. And again, these are going to be for a little bit more advanced individuals that are trying to pick a certain type of asset class. So for the most part, what I would recommend going with is the allocation asset. And then as you go through and start to look at those individually, so for example, with international equity, this is one of the areas that I'm fairly heavy in right now for emerging markets. So you can see you can select if you want China region, you can select diversified emerging markets, Latin America. So you can focus on a certain area, a particular region. So these different asset classes are going to allow you to do that. And then when you look at commodities, you'll notice things such as oil, gold. And then when we move on to money market, these are going to be short term. And the nice thing is down here, you'll see that they're lower risk. So this also does have a nice scale for you. So you can see with equities, international equities, you're going to notice it's going to be higher risk. And then something such as taxable bond is going to be lower risk. And then you have municipal bonds and US equity. Now, so when we go through, for example, we're going to select, actually, we'll go with the allocation, and we'll say we're shooting for a target date of 2050. And so what this is going to do, it's going to show all the funds that currently have the no transaction fee. And over here you have the overall rating. And again, this is going to be based off Morningstar. So if you go to Morningstar's website, they'll go through and explain how they come up with the ratings. And so what we'll do for this is we're just going to leave this blank. And then you can go after different returns. So if you're looking for a higher return, you'll notice, again, the risk is going to go up. So as you increase your expected return, your risk is also going to increase. For the most part, there are some special circumstances in history that have happened before where that hasn't necessarily been true. But for the most part, the return, the higher return is going to have a higher risk associated with it. And then over here, you can go through and select the expense. Now, personally, I would recommend going with the lower end funds, and we'll explain that a bit later on in our videos about time value of money. So for right now, you'll want to go with a lower expense. So we're going to go ahead and select this. So there's 4 mutual funds that fall under the categorization that we just set. So we'll go ahead and see results there. Okay, so here what you'll notice is you'll have a general overview. This right here is going to be the year-to-date performance. And then also you have what was the performance for the last year, 3 years, 5 years, and 10 years. And again, things to keep in mind is some of these mutual funds haven't been around. So the inception date may have been, say, or 2018, you'll notice that they won't, these areas are going to be blank. So for example, this one that's been around for a while, it's been around for 10 years. So you see that they have a ratio in here. And then you have your expense ratio. So the expense ratio is going to have, it's broken down into 2 different parts. You have the net and the gross. And again, one of the things that I would recommend if you're looking for something that's fairly low cost, you're going to want to look for something that's below 20 to 25 basis points, or 0.20 to 0.25%. So you'll want to look for a lower expense ratio when you're going through your funds, again, unless you're after a particular fund and you're okay with paying that additional expense. So these are the Fidelity matches. And then down here, we have all of them. So that you'll see right here is a Wells Fargo target 2050. And then if we click on the risk tab, you'll be able to see where the current risk, if you put your mouse over it, you'll be able to see the risk rate rating on there. And it shows you from lower to high. And again, since we have 2050, it's going to be more towards the higher end. The next thing that you have is, I focus more on the beta. And the beta is basically, if you look at what the market has done, what does this fund do in comparison to the market? So a beta lower than 1 will have less volatility. So for example, it's right here, we'll use this fund. So you have a beta of 0.89. Means when the market goes up 10%, this fund should go up about 8.9%. So its volatility is less than the market. So you're not going to have as big of swings up and then also in the downward direction. That's one thing that I would focus on the risk tab. Now, when we go to management and fees, this will have a breakdown. So you'll have the inception date, how long the manager's been with the mutual fund. Then you'll also, over here, you'll have a turnover rate, and then the minimum initial purchase, so the minimum amounts to actually purchase the fund. So for this one right here, that the 99999, that one's, I'm assuming, is an error on there. But if we look at the Wells Fargo one, for example, they have a $2,500 minimum. So you need to at least purchase $2,500 worth of that particular mutual fund in order to purchase it. And then over here we have the load. So this is going to be, again, coming back to the front load fee, which is basically any time that you go through and you pay a fee at the beginning to purchase a mutual fund, that's known as the front load fee. And then on the back end, some will have it just on the back end. So you can purchase it without paying any type of load fee, but once you sell, you will have to pay a load fee. So that's one thing that's important because, again, it's a big thing that can eat into your portfolio. And then if you go over here, the Morningstar ranking, how this fund ranks in comparison funds. And so you have that broken out the last 10 years. And then income characteristics. And this is more for bonds. So for example, if we looked at a bond fund, we may notice that the average duration is 6 years, or you have a 30-day yield. So this tab is actually more for bonds. Most of you won't use it if you're just looking at a variety of different asset classes. The only ones that will are going to be income-based. So if you have any bonds, anything such as that, then you'll find this useful. And so that's just a quick overview of how to use the tool. Just a few extra things to point out. On the left side, you'll notice that you have fund management approach. You'll have active and indexed. So is it actively managed or is it based off an index? And so you'll notice with the actively managed ones, they're usually going to have a higher expense ratio. They're more likely, again, to have those extra fees associated with them, the front load or the back end load. All right, and so for the Yahoo Finance, we'll go ahead and if you go to your web browser and type in finance.yahoo.com, you'll see they have it very easy to find. When I click on My Screeners, we'll see the mutual fund screener right here. So if I click that, all right, so over here, you can add an exchange. I'm going to go ahead and remove that. So the category name, again, this is going to be very similar to the Fidelity. You can go through, the only difference is they don't have the subcategory, but you can go through, we can try emerging. We'll go for diversified emerging markets. So once that's been added, if I wanted to go through, I could add an additional one. So let's see if they have the target dates on there, and they do. So we'll use the same we had with Fidelity. So I'm actually going to close, so you can see that we have 620 different results. So we're going to close out of diversified emerging markets. Okay, now we have 135. And then you can go back through and we can select financial institutions managing these mutual funds. So you'll see Fidelity, BlackRock, some of the big ones on there. So for this one, I'll go ahead so we can see how similar these are. So we'll use Wells Fargo and then also Fidelity. Over here, you have the same type of thing. Anytime that you see the ranking for mutual funds, it's usually going to be associated with the Morningstar rating. And you can go to Morningstar to find out a little bit more about what they use to come up with that score. So I'm going to go ahead and click Find Mutual Funds. So we're going to go ahead and look at our search results here. So we have a number of different Fidelity and Wells Fargo funds. And again, you'll notice with this, they have a little bit of a different breakout. The intraday price, 50-day average, 200-day, and so on and so forth. If we go through, you can click on one of these to find out more information. It'll bring you over to the Summary tab. So this is showing you how to use the screeners to find your mutual funds. In the next video, we're actually going to go through and cover some key things to look at as you're going through and trying to find a mutual fund. Personally, I recommend using Fidelity, and the reason why is because you can go through, you can view the information at higher level. For example, if we had all of these different mutual funds, we'd be able to look at risk, performance, and a number of different things without actually having to go through and click on each individual one. So that is one nice thing that Fidelity has done a great job on, as far as making it as easy and convenient as possible to go through and research the mutual funds.
And I hope you found this video helpful. In our next video, we're actually going to be covering, when you go through and you're looking at mutual funds, what are the different things to look out for? What are some risks associated with the funds? And a number of different things to watch out for. Also to better understand the expense related to that mutual fund. So we'll cover that in the next video. And if you like this video, please subscribe, and we'll have a lot more coming.